All right, everyone. So now what we are going to do is blend the concepts introduced to you in our core concepts lectures into top-down worked examples. These examples are going to bridge the universal model that I told you about, as well as the concepts you learned through the fundamentals of open, high, low, close, swing formation, cracks and correlation, phase of price, and all the way down to entry techniques. By the end of this module, where you see me work top-down examples, you should be able to blend the concepts presented to you in the course to frame high probability, multi-time frame trades using swing point formations. Okay, so let's take a look at exactly how this works, and let's start with a unique example of a monthly chart. Now, this is a chart that we as day traders rarely look at. However, in the case of this specific example I'm going to show to you, I'm going to show you exactly how this idea of everything presented in the course is quite fractal, meaning as long as you identify the logic for the model, it can be applied to any time frame. So let's start with the universal model at play here, and let's take a look at this example from internal range liquidity to external range liquidity, okay? So this is trading from our fair value gap to our swing high. And this entirety of this move is framed as a market maker buy model on our associated lower time frame. So as we can see, we have a monthly chart here, and we are now going to drop down and look for the daily market maker model that forms from this monthly internal range of liquidity. This is going to be known as our universal model, of course. Okay, so now as you can see, let me make sure we bring our checklist over here, just so we're understanding the key concepts in play. Let's take a look at what happens inside of this monthly fair value gap. So what we see is that price opens the monthly candle in a certain area. Let's mark that out here. I'm going to use a dotted line, and I'm just going to call this our monthly open. Okay, so price opens this monthly candle, which contains the fair value gap below it, here. And what we immediately do is we form a manipulation lower. As you can see, this expansion is met with expansion back into the range. As you've learned, this is a formation of a reversal. Now, if we look to the left, you can see that there is a clear draw on liquidity, being this original consolidation high that we want to target in the market. So if we are able to frame a reversal from this monthly internal liquidity, we can look to trade into these consolidated highs that we have left on the sell side of our curve. So how are we going to qualify a reversal in this internal range of liquidity? Well, that is how we look at relevant swing formations and cracks in correlation. So what we want to observe in this monthly fair value gap is going to be a two-stage crack in correlation to confirm the reversal, followed by a change in the state of delivery. So let's take a look at the other assets in play and see if we can find that crack in correlation. Well, the first thing I want to do is I can look on my monthly chart and see that this fair value gap is indeed diverged at. So you can see that NASDAQ fails to reach into this gap while the YM does, and this is equivalently true for the S&P 500. Now, importantly, we're also going to note that this is a precision swing point. So this becomes a two-stage PSP into that monthly internal range of liquidity. As you notice, NASDAQ prints a up-close candle here, right? An expansion phase of price, while YM is forming an open high-low retracement. We take the low of that precision candle into our key level, and then we see that reversal signature higher. So once this two-stage PSP forms, we can qualify that reversal. And how are we going to qualify that that swing is formed? We're going to use a change in the state of delivery. Okay, FEs, well, the change in state of delivery isn't all the way until up here. So if I wanted to trade this on the daily time frame, does that mean I have to wait for this consecutive series of opposing candles to be closed through? And the answer is no, right? As we talked about using our entry functions, we can look at the price action inside of here and evaluate if there is an early indication of reversal. One of those signatures will be this inversion fair value gap, meaning that price has disrespected, right, a bearish PD array in the expansion leg lower. We can also look at our correlated markets and look and see we have a new crack in correlation before the expansion higher. So if we look at our weekly chart, you're going to see that once we form this wick low in here, as price reverses, NASDAQ makes another opposing run lower, right? Trading below this weekly low. We form another SMT like so. And if I go down to my daily chart, you'll be able to see that in here. So once we form this SMT as well, you can see we are forming multiple time frame SMT here, right? And price now is in an expansion phase. So how could you enter this? Well, as price trades into this fair value gap, if you were trading the daily cycle or the daily market maker model, you could be entering in this fair value gap as the market expands higher and taking a position that looks as simple as this, right? Targeting these all-time highs. Now you could also refine this and trade intraday like we did over the past couple of weeks, but I hope you can see here that the concepts that you've learned, right, stemming from that universal model to opening high-low close or opening low-high close, relevant swing formations, you see, this is a relevant swing that forms, as is this swing because it's protected with SMT, right? We have crack and correlation at each of these new phases of price, and then we can use entry techniques like inversions, changes in the state of delivery, and fair value gaps. As you notice in this entire leg, bullish PD arrays are respected, bearish PD arrays are inversed, and we see opposing candles support price higher. So this would be a complete worked example, right, of that monthly internal with reversal signature and two-stage crack into a daily market maker buy model. The last thing I want to point your attention to specifically is how phases of price blends into this argument. So this chart here expands lower into this key level, and that expansion is met with expansion higher. This V shape is our reversal. Then you can see price in here forms a phase of retracement, which is characterized, as we talked about, with failure swings. What are we retracing into? And another internal range of liquidity targeting the external range high, right? This is another fractal that we'd be trading on a lower time frame. Now price expands once again higher, and we can now use the phase of price argument again. So if we look at these highs, we can see that price fails to manipulate, meaning we do not reverse off of these highs, so we can anticipate continuation. In here, we have a new phase of price, expansion into what? Consolidation. This consolidation in here is not going to reverse as well. So once we consolidate, we will have a new phase of expansion, a new phase of retracement, right? And then you can see price delivers finally to our draw on liquidity. So this is a very interesting case study in phases of price as well. And what I encourage you all to do, right, as active learning members, is to go into your charts here and find the cracks in correlation. Cracks in correlation that are at each new phase of price, and prove to yourself that the market is reversing with these two-stage divergences we talked about, right? These are things like PSPs plus SMTs. These are things like two-stage SMTs. These are things like SMT fills, SMT with swings, etc. Each new phase of price is bridged by a crack in correlation with the associated triad, NASDAQ and ES in this case. So your homework can be to prove to yourself that this entire mechanical kind of expansion, right, from expansion into retracement into expansion into consolidation, all of this steps and framework, right, is governed by the same logic that we have taught you for day trading, and it can be applied to any time frame chart. So I hope this is a unique example, maybe some example you haven't considered before, that really proves to you the robustness of this logic, right? Not only can we day trade these concepts, we can also potentially swing trade them, right? Or trade them on time frames that aren't necessarily intraday because the logic is consistent. As long as we understand how these concepts blend together, any chart, any asset, and any time frame can be traded. I'll see you guys in the next example.